Well, that's right. Well, let's get straight to the next management we have on the show. That's Macrotech Developers. The stocks on our radar, the company reported a pretty good set of numbers, actually. The collections rose by 26% on a year-on-year basis, along with a healthy surge in the profitability. They have guided for around 21,000 crores of pre-sales in FY26. To discuss this and more, we're now joined by Mr. Sushil Kumar Modi, the Executive Director of Finance at Macrotech Developers. Hi, sir. Good morning. Thanks a lot for joining in. The street likes your numbers and the guidance they've given as well. Before we get number specific, tell us on ground, have you seen any kind of slowdown in terms of demand? Have footfalls reduced? Or is demand as strong as, say, what we saw 3 or 4 months ago?
Hi, Nigel. Good morning. Nice to be on your show. Now, as you can see, the last year number itself speaks about the structural strength of our industry and the branded participants in the industry, how the consolidation is playing out, and which is where you would notice that we have outperformed all the matrices on our guidance, be it the pre-sales, which has grown by 14% this quarter to 4,800 odd crore. And for the year, we delivered 17,600 crore, outperforming our own guidance of 17,500. Embedded EBITDA margin on the pre-sales also came out at 33%, again outperforming against our guidance of 31%. Thereby, the embedded EBITDA on the pre-sales turned out to be 5,900 odd crore, delivering 35% growth. So, again, if you take it on the business development, we guided 21,000 crore. We outperformed significantly by around 12%, delivering 23,700 crore across 10 projects and obviously across the 3 cities that we operate in. So net, and as you rightly said, the collection represents the execution capability. The pre-sales is one, but the execution capability converts those pre-sales into the hard cash, and that is where our operating cash flow was dot on guidance, delivering 6,500 crore. And if you relate this strength of the operating cash flow and combine alongside the fact that we did significant business development, thereby meaning a significant investment, our investment this year was 7,000 crore plus the construction cost of 4,200 odd crore, means income total 11,000 odd crore of investment. Yet we could deliver the very conservative capital structure where the net debt to equity is at around 0.2x, significantly below our guided number of 0.5x. And this is what has kind of enabled us to get to the credit rating of AA, which is at the beginning of the year we were at A+, and now we are at AA by CRISIL. So net, the trajectory of our business in the full year, we are pretty much on track, and that is what has given us the confidence in terms of, as you pointed out, guiding for the next year, growing by 20% to 21,000 odd crore.
Yeah, I'm looking at that guidance, 21,000 crores in pre-sales. Your launch pipeline is 31 million square feet, gross developmental value of about 18,800 crores. Give us some sense also of pricing, Sushil, and margins, because in Q4 your margin improved quite a bit. I think I'm just checking the numbers. I think it came up to 28%, if I'm not mistaken. 28.9%, that's almost 29% margin as you've ended the year. Is this sustainable? And, does the market have some room, some scope for price hikes?
Hi, Shirvi. Morning. No, you are right. So as I said, we delivered our embedded EBITDA margin on the pre-sales at 33%, and so is our guidance for the next year to be 33%. And this is pretty much in line with what we have, time and again said, that we look for delivering 30% plus of the EBITDA margin. And our industry and the product is such where a reasonable price increase is always being appreciated, be it by the existing owners of the asset or the new buyers, because so long the price growth is more like below the salary growth of the consumer, it only enhances the affordability metrics, right? And which is where the demand gets consummated, which in any case is structurally very strong. So we clearly see that so long the price growth we all carry to the tune of 5, 6, 7%, knowing well that the salary growth in any case in our country is more like 8 to 10%. That kind of only entices the demand to consummate, because people find it affordable to consummate their basic necessity, which is housing. So yeah, thereby, as you have seen, be it last 3 years, year on year, we have maintained the trajectory of price growth in the ballpark of anywhere between 5 to 6%. We clearly see that similar thing happening, in the upcoming year as well.
Good morning. So you're saying price growth of 5 to 6% possible?
Yes, Prashant. Yes.
Okay. So I had you put out all the numbers, etc., and we can talk more about that, Sushil. But there are two players who are very, very aggressive in the Mumbai market now. Not actually new players. One is Adani. They're buying up a lot of land parcels, very aggressive. And the other, of course, is Prestige, again going full tilt. Could you give us a sense of how this is likely to change the landscape? I mean, will it still be volume-led push in terms of growth, or will you recalibrate that a little bit as things go forward? What's your sense? Will it be more consolidation and kind of sort of protecting your margins, or will it be full tilt on volume growth?
Prashant, you rightly used the phrase consolidation. So our industry, post-COVID is seeing a dual consolidation actually. Be it on the demand side, where consumer having burned their fingers big time in the pre-COVID era, buying from tier 2, tier 3 developer, the entire saving potentially has got lost, never even delivered a product. So the consumer in any case is now absolutely gravitated towards only buying from a top-notch brands. That's one. And so is on the supply side. So, even the land effectively end up in going to the top-notch brands like Loda. So these kind of consolidation on both front is not really been seen across lot many industries, perhaps to my knowledge. So you can see in any city that in our country across the top-notch brands are performing good. The people going from one city to another city, that will be an ongoing affair, and obviously that every participant will have different strategy in terms of growth, how many cities that we want that they want to operate. In our mind, the business is reasonably regional, and thereby we should be going more and more deep into any city that we choose rather than being wide across lot many. So more the participants that come into any particular geography, and so is, as you know, we have gone to the Pune and then to the Bangalore, right? So that only leads to the consolidation effectively is strengthening more and more. By now, perhaps the consolidation in the industry has already reached to around 30%, and there is no reason that it should not go towards 50% plus in few years' time.
Sushil, one more question specifically on the Mumbai market, and this stems from a note that Nuvama put out, not on you actually, there was a note on your peers, Oberoi Realty, and Nuvama was pointing out the risk of high inventory and whether inventory can be liquidated quickly enough or not. Give us just your overall, pan-India inventory position right now and the estimated timeline for liquidation. And in Mumbai itself, is inventory pile-up becoming an issue?
So actually the situation is quite reverse. We,
okay.
In our industry, typical gestation period to deliver a project, is anywhere around 3.5, 4 years. And the situation has come to the extent that the inventory levels across top 7, 8 cities has gone down to below 2 years. Mumbai, perhaps it will be more in the range bound of 15 to 18 months. And so is the journey in, other cities. So really challenge is that, the inventories is only depleting, and obviously we will not be able to comment about any specific participant, how the inventory level with those participants are. But as we know, as a city level, the inventory level has gone down significantly, and which is where the consolidation comes into effect. Because now, from a new supply standpoint, when you look at how the industry is playing out, effectively, perhaps the consolidation in terms of the new supply has gone beyond 50% already.
Sushilji, very quickly, you're not sounding too perturbed with regard to demand, but where is demand better, mass or premium?
See, Nigel, this is across, right? Because the housing at the end of the day is a necessity. So, obviously the affordable and the entry-level segment has somewhat got impacted in last 18, 24 months because of the rising interest rate, where we know the repo rate has gone up by 250 bips odd. So to that extent, the entry level got suffered. but which is where the tailwind now, right? So as the reverse trend on the interest rate has commenced and the 50 bips has already gone down, and perhaps maybe another 75, 100 bips, whatever comes, that will only lead to strengthen this segment of the market, which was so far kind of not fully getting unfolded, and which is where Lodha gets an edge, because we are the only participant who perhaps cater to the entire segment, be it the entry level, mid-income housing, to the premium housing, to the luxury housing. So the business model of ours being so diversified, in terms of the audience, the segment that we cater to, the various locations that we cater to, we delivered 17,600 crore, but more important is we delivered from 642 odd locations, which means on an average, an individual locations effectively delivers 500 odd crore of sales. So that means we are neither dependent on any individual segment, nor are we dependent upon any city, or nor are we excessively dependent on any location. So that brings the resilience and the robustness of the business model that we have, and which is what then gives us the confidence, in spite of whatever global macro playing plus and minuses we reckon that. But nonetheless, we feel that our resilient business model should be able to deliver 20% growth in terms of the pre-sales in the next year.
Absolutely. Sushil, take your point. Diversification, always a good thing. Thank you so much for joining in. Have a good day and good luck with the year that we are in now.